Well, hello, everyone. This is Morgan Hill, CEO and founder of Hill and Hill Financial with Matthew Parker, one of our key advisors here at Hill and Hill. And this
Hello.
is a session of Morgan and Matthew, and now we're going to talk taxes. I know we're just getting through the therapy sessions from the latest round of paying taxes this year. But it's always good to not just talk about tax preparation, but also tax planning. And Matthew, I think that's really the key. And what we were doing a session the other day. What was it that you said? It's not what you earn, it's
It's what you keep.
yeah, and I think I saw this thing years ago where it was a piece of paper and it had "the" and just a little bit of a space. It said IRS, and if you actually fold them together, it says "theirs." And I thought that was really interesting. That I think that's the ultimate goal: is whose money is it? You want it to be ours, not theirs. So, Matthew, as we were doing this session the other day, and you were sharing some really good tax planning strategies, we talked about these things called qualified charitable distributions. Can you kind of do a little bit of review what those are and how that might help our listeners with charitable giving and what they can do with their IRA distributions?
Yeah. QCDs, Qualified Charitable Distributions, have become increasingly popular, especially with the changes brought on by the One Big Beautiful Bill to charitable giving. What these allow you to do is to take a distribution directly from a qualified retirement account. So think your IRA,
Hmm.
and give that money directly to a church, a temple, a civic group, really any 501c without realizing that distribution as income that's taxable to you. So this has a twofold effect of lowering your tax bill while also leaving more money for the organization.
Yeah, yeah. We've talked, Matthew, I know you and I have talked with different folks, different clients. If you're in a spot, folks, where if you take this IRA distribution, and by the way, you can start at 70 and a half, even though mandatory distributions start at 73. You can take this distribution. If you're going, you know what, taking this IRA distribution, having it taxed as income, giving it to the charity of my choice, and then taking the write off. If you're finding that that's perfectly fine with you, great. But there are a lot of folks who, when they take this distribution, they're going, gosh, the standard deduction has made itemization just less robust and less quote unquote profitable, and we're going to give anyway. So can we just send it directly to this C3 organization rather than going through it comes to me, maybe bump me into a new bracket, all that stuff. So folks, if you find that this could be a strategy that's helpful, awesome. If you're going, it's not that big of a deal, I can take the money, give to charity, get the write-off, and I'm fine, then a qualified charitable distribution is not needed for you. And these things have been around, folks, for I think 15 years. They just now kind of have come into the public psyche, if you will, that says, hey, I was giving anyway, let me just give directly. So qualified charitable distributions is what people are finding a helpful tax and really an annual tax planning strategy. So,
Definitely.
you talked too about IRMAA, Matthew. I remember your session the other night, and that wasn't your great aunt, right? IRMAA. What kind
No.
of breakdown? What's IRMAA?
Yeah, IRMAA is an acronym. It stands for Income Related Monthly Adjustment Amount. And so this is when Medicare does their 2-year look back period at the beginning of every year, they look to see your earned income
Hmm.
2 years ago on your last filed tax return. And if your earned income is above a certain threshold, they'll tack on monthly premium surcharges to your Medicare. And you most commonly see this with Roth conversions because those show up as earned income on your tax return. So it's just another thing to be mindful of. We always like to say the boards and bricks have to meet up, and so everything's connected in your income.
Yeah, folks, as you're doing, and as I've just, experienced this, one of the biggest areas of budget shortfall, if you will, I'm not here to get into a debate about the annual budget with our government, but people often go, what about Social Security? And I said, really, it's healthcare, Medicare, Medicaid, children's health programs. And so they're working to find ways to say, how do we mitigate the cost? And this IRMAA one, again, as Matthew shared, they look at what your income is. And so Medicare Part B, like boy, D, like David, prescription drug. I'm experiencing it now. I get that letter that says, hey, you've done really well. Here's how much more you're going to have to pay. And then there was a year, Matthew, where I hear this burst of excitement from the kitchen around the corner in my house, and she'd gotten the letter that my premiums went down just based on, income reported, et cetera. But every single year, they're doing this 2-year look back. The first thing I always share, and I just got out of a conversation a few minutes ago, I said, live your life. I have people that I have met over the years who try to live their life based on a tax bracket. I said, I wish you the best, but that's kind of difficult. Well, I'm not going to earn this much or take this much because I want to stay under this amount. I said, do as you choose. But if you are pretty close, it's kind of like pickleball, you don't want your toes right over the line and then you get called for a foul. It's just being cognizant of it. And there's online, you can get the guidelines and say, here's 26, what happened in 24. Here's 27, what happened in tax year 25. And if you're kind of around those areas, you just don't want to trip the trigger and perhaps increase your Part B and Part D Medicare costs. And so IRMAA, folks, as Matthew also shared about when you're doing these Roth conversions, when you're taking these IRAs and now doing Roth conversions, those come out as ordinary income. And we've had a lot of people going, man, I'm really excited. I want to get this tax bill down. And while they're doing one thing with the Roth conversion, kind of like building a house, you're going, I'm really focused on this left side wall and not realizing that when it's all done, I'm still an inch apart for these two walls to join. One side, I'm getting the Roth conversions taken care of. On the other, I'm jacking up my Medicare premium. And so that's where we want to just be watching as much as we can how all of these things fit together. That's one of the things that we do here at Hill and Hill. Matthew, CDs have become, obviously, it's been fun the last few years, right? Woohoo, I'm going to credit union or bank. And it's been the game of how much for how short a period of time. We have been seeing some general decline of CD rates, right? But a lot of people that we talk to are saying, you know what, I like the interest, but I'm not using the earned income, the earned interest. And then you get that pesky 1099 at the end. It's like, I'm paying taxes on money that I'm not using. You shared a little bit about some of these 1099 tax deferral strategies. What's that all about?
Yeah, so this really gets into, it's not what you earn, it's what you keep.
Exactly.
And also the purpose of money. So if you have money in a CD because you like the guarantees and the stability associated with CDs and bank deposits, but you're not a huge fan of the downward pressure that we're seeing on interest rates right now. In addition, as you shared, the 1099 on the interest income that you get, it eats into what you're earning.
Yeah.
So there are strategies out there that allow you to, still earn that income, still have some guarantees and stability with the money, but you don't get a 1099 at the end of the year. So in effect, you get to keep more of what you're earning.
Yeah. And actually, the concept is called triple compounding. You earn interest on principal, interest on interest, and interest on tax savings. I've shared before, I've been doing what I do now for 25 years. In fact, this is the 25th anniversary of Hill and Hill. But prior to that, I was in the food business in a variety of different roles and responsibilities for a good 20 years. And I'll never forget when I was learning about yielded cost. If you go into the grocery store, people say, what's yielded cost? It's like if you go into the grocery store and you see a cheap price on a piece of meat, let's say, it's like, 50 cents a pound. It's like 18 pounds of whatever. And then you go home and cook it, and that 18 pounds becomes 3 pounds. You go on, I don't know that I got a great deal because I've only got 1/6. So it was cheap for the aggregate 50 cents a pound. But when I actually look at what it cooked down to be, it was $4.50 a pound or whatever the case may be. It's like I didn't get much out of it. One of the things we look at is tax equivalent yield. And so if you're, let's just say hypothetically, you're in a 30% tax bracket as your marginal rate. And you're saying, well, I've got my CD and I'm earning 3.5%. Well, after I get that 1099, my yield could be only 70% of that 3.5% versus all 100%. And so now all of a sudden I'm really getting like 2.4% because of what the after-tax yielded rate would be. And people go, dang, that's not that great. And so there are strategies that you can employ that just allow you to not have to pay an annual 1099. Now, we've done the math that even after, let's just say you had something for 5 years and you had tax deferral, tax deferral, tax deferral, we've seen even at the end of that term, when you do have to pay whatever taxes, what you've built up by earning interest on your tax deferral, you still net more money at the end of the term with tax deferral strategies than paying tax each year on money that you're not using. So the key is it's not money that's your quick rainy day. It's not money that you need for any emergencies. It's not the money that you need to buy the car that you're going to get next week or something else. It's money that is kind of in that unproductive category and you'd like it to do more. And you go, boy, if I could do this without getting clobbered with an annual tax bill because it's not money that I need to tap into, that could be a strategy that works. And so, as we look at taxes, folks, I think we can all agree, Matthew, you've talked about it as you're going through basically tax training to become what's called an enrolled agent. Haven't met anybody. This isn't a political discussion. I don't know anybody that wants to pay taxes, period, let alone any more taxes. And what we just want to highlight is it is not what you earn, it's what you keep. And Matthew, I think we can agree. We've been surprised at how little folks get as far as information on tax planning versus tax preparation kind of is all the oxygen in the room because, oh, I got to get this filed and and that's very, very important what you may owe or what you get as a refund. But there's bigger thoughts and ideas around the planning side of things that a lot of folks go, I haven't heard some of these things.
Certainly. Yeah. I mean, tax planning is equally as important as tax preparation. Just making sure you know what you're going to be facing next year. I feel
Mhm.
like a lot of people go into tax season blind, not really knowing what their tax bill is going to look like. And so a
Yeah.
little bit of tax planning on the front end can go a long way in making tax season more bearable.
Yeah, yeah. I remember as a kid growing up, we used to have these little brown paper bags, and they'd have a dollar, it'd be like a dollar, and you kind of had grab bag, and you had no idea what was in the bag. You paid the money, and you open it up, and I'm always thinking about Charlie Brown Halloween. Remember, they would after they visited a house, they'd look. I got a candied apple. I got a this. I got a that. And Charlie, they say, "What'd you get, Charlie Brown?" I got a rock. I think sometimes we're doing taxes, just like, "What'd you get?" Well, I got a rock, and we just want to make sure that all of the prep, absolutely, if you do your own taxes, great. If you have professionals that you work with, we've got tax professionals that we seek their assistance as far as they would do tax preparation. But as we do tax planning, it's not just about QCDs or 1099 deferral or IRMAA. We also look at things like what do you have? I've owned this rental real estate forever and I enjoy the cash flow, but I'm kind of done with, fixing holes in walls or toilets on Christmas Eve. How do I move out of that? Things like 1031, 721 real estate exchanges, Roth conversions. Again, it can make all sorts of sense. And sometimes it could be maybe an idea that's not best suited for you. If you have investments that you want to move that are tax deferral strategies, how can I move from one to the other without getting hit with taxes? There's something called a 1035 exchange. So, folks, all this to say is there's more to the tax discussion. Prepping is critical. Planning is also critical. And we just, between these podcasts, as well as our public events, as well as even some private events, you just want to say, what are the things that are out there and what might be appropriate in my best interest to make sure that we keep as much as we can. And as Matthew said to start, it's not what you earn, it's what you keep, and you're keeping more, right? So, just as a quick reminder, as we do what we do at Hill and Hill, taxes is just one piece. We look at investing, we look at investing in income, risk management, estate planning with teams of attorneys to really look at all of those areas of retirement planning to make sure that if we kind of use that analogy of building, it's the house that you love and it's solid, all the load bearing walls are in good shape, and you really live the dream that you've been dreaming about for decades. So, Matthew, any closing comments before we wrap up today's podcast?
Yeah, just wanted to encourage everyone to take a minute to take account of, are you giving thought to tax planning? As we touched on earlier, tax prep, obviously important, but tax planning, equally as important.
Absolutely. Folks, thanks for tuning in. As always, our number here at Hill and Hill is 800-887-9647. Feel free to call in and make it a great day. Thanks again.